we have a trade deal, maybe, that's been restored with China, and the inflation data is not as bad as people were thinking it might be, but the markets are not particularly enthused. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we're going to try to figure out what's going on here and what these markets took away from all of this information, and whether they had a reason to rally and should have, or maybe didn't and might. That's the front of mind question here, and we'll focus the discussion with a check-in on China whilst they're in the conversation and grabbing headlines, because needless to say, this is a very important part of the overall macro puzzle, this trade war between the world's first and second largest economies, the U.S. and China. And so it's right on time for us to check in on just how that economy is doing, and whether they're giving us something that's a little bit more encouraging to look at for the global story writ large. So let's take a look at first what came out of today's news flow. The inflation data out of the U.S. came in a little bit cooler than expected, 2.8% on core, that's excluding energy and food, 2.4% on headline. We can see here that that's a little bit cooler than was expected, though it is an upturn from April's numbers. 2.9% expected, 2.5 on the headline. So these numbers were a little bit more encouraging. Looking at the internals is really where the meat of the story seems to be, because once again, as in May, these are refreshingly normal kinds of numbers. So if the concern was that we were going to have some sort of an inflationary spike on the goods side, thanks to the tariffs that have been levied, then we don't have that here again. The contribution from the goods side to overall inflation, just 0.05 percentage points. It's a little bit higher than the 0.02 percentage points in April, but still not a whole lot to look at. The numbers for food and energy basically in line with recent averages. Energy, a disinflationary contribution by a similar margin as the previous month. Food, same thing. The bulk of inflation still buried in services, 2.21 percentage points of the 2.4% overall headline figure right here is services, and about 0.19 percentage points is everything else. So when you look at all of this, you get a sense that maybe things are relatively okay here, and we don't need to be concerned. But of course, we saw this movie in April, and when the markets had this 2.3% number, 2.8% at the core, which holds steady this time around, the market said, oh, goody, everything is normal. Everything is mostly in services. Everything over here is still subdued. So no real change from the recent dynamics. Everything still looks about the same. But then, of course, we got the PPI data, which told us that the reason we didn't see it in consumer confidence, and this is for April, we haven't gotten the May ones yet, that's tomorrow, we saw that there was a shock negative reading here, and what that reflected was this dramatic 1.6% negative number on PPI for services, and the services in this particular context speak to trade services, that is the cost of moving goods around the supply chain, basically the cost of getting them from where they're made to where they're going to be sold. And what this shows us here is that it's not that the inflation didn't come as a consequence of the tariffs. In fact, we can see it building right here. And if you look at this errant spike here in 2023 as a reference point, then it's the highest in 2 years. And if you don't, then it's the highest, because after all, it is just 1 month here kind of a one-off. If it's not that, then the reference point is this sort of COVID inflationary scare right here. So it's not like the inflation didn't come. It's just that businesses ate it. They just accepted lower margins. And by the way, significantly lower margins to shield consumers. Then, of course, we also saw that retail sales did not match the jump in March. In April, retail sales basically ground down to a halt. And the upshot, of course, then was businesses shielded consumers from inflation as a consequence of these tariffs, and consumers still didn't come. The increase month on month in retail sales was just 0.1% in April after a 1.7% surge in March. So it's not like consumers are beyond front running the tariffs, but even when in April they were shielded by businesses, they did not continue. That, of course, is the real story here, and we'll see if these seemingly benign CPI numbers are again smoke and mirrors for the situation just being held back at the wholesale level and being more of a problem for businesses than for consumers for now. So the markets rally on this briefly, but that only holds for maybe an hour, and then comes unraveling, and we end up with fractionally lower closes. Some of that is perhaps driven by a spike in crude oil around some evacuations of embassies around the Middle East, but we certainly don't have the kind of optimism that might be lasting as a consequence of inflation being a little bit more supportive. And indeed, Fed rate cut expectations looking a little bit better. We're a little bit closer to matching the Fed's outlook. It's 45 basis points apiece this year and next. That's only 5 points light from what the Fed was arguing for, which is 50 basis points apiece. So we're basically at baseline for policy expectations, but the markets don't run away on this. In fact, they sort of pointedly jump to a 4-month high and then retreat. The next bit that might have been positive news is the deal that was ostensibly struck between U.S. negotiators led by Scott Bessent and Howard Lutnick, the Treasury and Commerce Secretaries, with Chinese counterparts in London, where there was a deal done in Geneva, at least in words, and then the president got into a war of words with China's President Xi Jinping again, and the deal was ostensibly off, and now we've just had talks in London where things have kind of been resuscitated and we're back into a steady state, a kind of day after Geneva sort of setting, and it is against that backdrop that it seems to make sense to check in just how China's economy is doing and how the world economy is doing. Because this entire situation really has to do with, are we going to get some help on global growth, either from fiscal policy or from monetary policy? Because the question still is, are we going to be able to duck recession as a consequence of everything that's going on around the world? And we once again come back to the idea that the global economy is really powered by 3 engines: the US, the Eurozone, and of course, China. With the US the largest, at just over a quarter of the overall pie, China 17%, Eurozone 15%, the rest of the world 42%. So between the 3 major economies, we have 58% of global GDP. And when we factor in that the remaining 42% are mainly vendors to those 3, they depend on being able to export to those 3 and into the supply chain that feeds those 3. So think about, let's say, a commodity producer like Australia or Chile selling things to China, which then end up getting turned into more finished goods for selling in the Eurozone and the US, and of course, mainly the US. And so all of these things really depend on end demand in rich world countries, mainly the US and also Western Europe. And without them, without that demand, the rest of world 42% don't really have much of a contribution to make independently. So it's really the top three, with China kind of in the middle of the supply chain, but because of its size, still vastly important, that we need to be watching to see just how real the threat is looking. And now that we've gone through the PMI reporting rounds, both for S&P Global and for alternative measures, the U.S. has ISM, China has the official numbers from CFLP and NBS, in addition to the S&P Global numbers, we can get the sense that the global economy is doing XYZ thing. And of course, we can see here very clearly that the story since the beginning of the year has been the U.S. decelerating and approaching the standstill that we have on display in both China. We have both measures of PMI here. They're basically versions of standstill. The official numbers a little bit weaker, 49.6. The S&P Global numbers a little bit higher, 50.4. But of course, in the logic of PMIs, 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. Readings plus or minus a little bit, but pinned to 50, tell us that China's economy is at standstill. The European economy is at standstill at 50.2. And so we saw that this has been something that's been the case really going all the way back to early last year, where through the first half of the year, we had this deceleration in both the Eurozone and China, and we got to standstill, and we've basically been sitting there since. The story for global growth was a robust and strong U.S., which by the end of the year was growing at some of the fastest rates that we'd seen going all the way back to 2021, 2022, over here. But with tariffs and with all of the various things that have beaten back business confidence and consumer confidence, we've seen a significant slowdown. Now, for the month of May, we have a little bit of an improvement in the U.S. story, although the trend still points lower. Output seems to be rebounding, or the pace of economic activity seems to be rebounding a little bit, looking at the S&P global version of the numbers. But the anemic situation elsewhere remains. And the data that, in particular from China, that we've seen is the most eye-catching. Now, for the Eurozone, yes, we're at standstill, but even the ECB last week said, as it cut rates, that it's nearing the end of its cutting cycle, because next year we're going to have all these outlays on defense spending, and that's going to boost both growth and inflation, and the euro is higher for it. So perhaps the story is on track to change there. But for China, the situation's still very anemic indeed. In fact, just to run through some of the data that we saw this week so far, we're looking at inflation that's in negative territory, headline CPI at 0.1% on the downside, negative 0.1%. For a third consecutive month, whereas the wholesale price index, PPI, staying negative, but more importantly, dipping deeper into negative territory. So at down 3.3%, we have the most negative reading on wholesale inflation since July of 2023. Which, of course, tells you that price pressures not only are negative, they're waning. They're turning more deflationary. Generally speaking, when there is robust demand, prices rise to reflect that demand as would-be buyers of stuff compete for that stuff, and there's of course a finite amount of stuff at any given moment in time. So when demand outstrips current inventory, current supply, prices rise. When we see negative prices, it is the opposite. That is to say, demand is weaker than current inventory and current supply. So we're seeing that wholesale prices here going negative just tells you that demand in the pipeline at the wholesale level is exceedingly weak, whereas demand at the retail level, that is consumer prices, has been basically an anemic flat line going all the way back to, let's say, the middle of 2023 and has made absolutely no headway since then. Looking at imports and exports, we still see a little bit of a positive reading on exports, 4.8% year on year. But of course, that now takes us to the bottom of the range that has prevailed since the middle, let's call it, of last year for export growth after some pretty heady numbers here. At one point, the numbers were even in the double digits. The March figure was north of 12%, then a fairly strong 8.1% in April, but we've now come back to the bottom of the range, telling us that whatever front-running of the tariffs there was is perhaps running out of steam. Meanwhile, the import side, that is a reflection of both the buying of inputs to feed that front running of tariffs and also to feed domestic demand, that might be fizzling back to negative territory on imports. Data upcoming for the next several days, due early next week. Industrial production seen cooling down to 5.5%. Retail sales seen cooling down to 4.7%. To put this in a little bit of context, 5.5% industrial production growth would be the weakest since November 2024. 4.7% retail sales growth would be the weakest since February of this year. So meaningful downdrafts on both measures of economic activity. And of course, all of this boils down to the story that we've been talking about for a while now in GDP numbers. So China's economy here still telling us, as of the first quarter of this year, and indeed, we can see here, these numbers have been negative now for 8 consecutive quarters, that real GDP growth, that's this solid line here, is running hotter or running above than nominal GDP growth. Now, nominal GDP growth is calculated as real GDP plus the influence of inflation. So real GDP takes inflation out of the picture. If real GDP minus inflation is higher than real GDP plus inflation, that tells you that the inflation component is negative. You can see that right here. This is the spread between the two, and what you're looking at here then is quite a sizable negative read, which basically tells you the economy as a whole is in a deflationary malaise. Now, we just talked about what this means, but to kind of put a clear point on it, it is as though the entire economy is in the bargain bin. It's on discount. Prices are falling because there isn't demand to clear these inventories, and so prices are declining economy-wide to try to stoke that demand, and for 2 years straight now, it isn't working. And the economy is basically idling at standstill at best, but struggling to have any kind of growth of any kind at the economy-wide level because there's a near total absence of uptake. And all of China's various stimulus efforts seem to be perhaps starting to show a little bit of light at the end of the tunnel. This is Bloomberg's measure of the share of new loans in GDP, the Credit Impulse Index. And for the first time in quite a while here, what we see is that there is a positive contribution from new loans to GDP in April. Now, in year-on-year terms, we have a rise of 4.2%. That's surely better than all of the negative numbers, and this is the first positive contribution from new loans to overall GDP since January 2024. So this is perhaps a little bit of good news, but when we look at what all of this translates into as far as actual consumption, we see that the spread between new money going into savings and new money going to consumption continues to get worse. The yellow line here is household time and sort of similar deposits. So think of this as savings and CDs, and in U.S. terms. And this is demand deposits in the red. That's essentially the equivalent of a checking account. So this is money earmarked for near-term consumption. This is money earmarked for saving. We can see the spread of new money going into saving versus consumption is widening and widening and widening and widening to tell you that there is really no impetus to consume from Chinese consumers. So yes, maybe we have some more activity here. Maybe people are starting to take some of this loan money, but it isn't exactly going toward consumption, and it isn't going toward feeding the economy. You can see that here. So with all of this in mind, we are left with a picture where the U.S. still looks like the most important game in town, and all of these talks between the U.S. and China may not be all that important unless they were to really clearly create certainty and really clearly open the spigots of trade between these two economies to try to generate some more activity. But in the meantime, we are in a situation where both China and Europe remain anemic, and of course, this deal with the U.S. doesn't particularly tell a positive story about where China goes from here, because it doesn't really change the bottom line for their consumer sentiment. And if the story in the U.S. is a little bit positive in May, we're going to have to see quite a bit more of it to get out of the woods here on this global recession risk, because still, and as we've looked at for over a year now, if this part of the story falters, there is no safety net. And that the markets are not celebrating lower inflation with perhaps hopes that the Fed will do something about this, that might be telling. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on with Victor Jones for the Price of Truth on Tuesdays, on with Chris for Futures Power Hour Mondays and Fridays, back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.